Welcome to Oregon Cash Flow Pro. My name is James Barber. I appreciate you joining us today. I recently did a video talking to you about annuities, basically an introduction to it. We called it Annuities 101. It's a great video to check out if you're interested in learning a little bit more about annuities and you don't really have experience with it yet. I mentioned in that video that I recently purchased an annuity. I'm going to share that with you today. We're going to talk about why I did it, how it fits in my overall retirement plan, so that you can get an understanding of why I might have purchased it. Part of the things that I think you guys appreciate about this channel is the transparency that we provide in regards to the products that I talk about with you guys. I share with you the things that I'm actually doing. We're eating our own cooking, so to say. I'm not asking you guys to get a policy that I myself wouldn't get in your situation. I'm very transparent about the products that I've purchased, why I've purchased them, and then I keep you up to date on those products. Be sure to check out my channel if you're interested in following along with all the updates that I do. I try and do an annual update on each of these life insurance policies that I own. I own multiple life insurance policies. This is the first annuity that I've purchased, and I'm going to tell you why that is when I get into the details of this. Annuities serve a particular purpose. Now, there's a lot of different purposes that they can serve, but at its base level, an annuity serves a particular purpose, and there are a bunch of different types of annuities out there that can meet different needs. So, I haven't had a need in the past for an annuity. I do in this situation. This annuity is going to help me meet a particular need in the future, and so we'll get into that. So stick around. I'm going to try and share with you all of that information about what I did, why I did it. And if you have any questions, be sure to leave them in the comment section below. If you want to have a conversation with me about your specific situation, maybe talk about needs that you might have in the life insurance space, whether it's annuities or life insurance, be sure to book a meeting with me. My Calendly link is down below, and I always look forward to helping you guys out. That's the best part of my day. Now let's get into this. This is the actual annuity that we just purchased. It is inside of a retirement account. You can purchase an annuity inside or outside of retirement accounts. For what I'm looking to do and the need that I'm looking for this annuity to serve, I really like having an annuity inside of a retirement account. And you can see this one is on my wife. So this is actually an annuity that's inside of her retirement account. This is an income annuity. That means at some point in the future, we're going to draw an income from it. I will explain more about that when I talk about this product, because there's basically income annuities and accumulation annuities, cash accumulation annuities. We're either going to potentially use it as cash in the future or turn it into an income stream. That's the basic breakdown of the two different types of annuities. This one, going to be used for income. You can see there's our cash accumulation. We've got a surrender value, and then we have the protected income value. This is often what we call an income bucket. We've got two buckets inside of this annuity. One is the cash bucket, and this can get depleted based on the costs inside of the annuities. Some have costs inside of it that'll slowly deplete that cash value, but the income bucket doesn't get touched. And at some point in the future, we're going to draw some income from the income bucket. But if we cancel it, we're just going to get what's available in that cash value bucket. So, like I said, I'll get more in depth on this in a little bit when I talk to you about this specific product. But for right now, I just want to show you what it looks like. We have a couple of different bonus options with this one. We can choose an accelerated bonus option or a balanced bonus option. And again, this is going to depend on, are you trying to accumulate growth in the cash value or in the income value? That's going to make a difference on which choice we make here. Now, I'm choosing the income bucket. We're solely focused on that. It's why I'm getting this product, because it has such a strong bonus in that income bucket. Now, I'll tell you right now, and again, I'm going to get into this in a little bit. If there was a possibility that I was going to pull this out as cash, I would not buy this particular product. There are other products that this carrier offers that are better if I'm going to do it for cash purposes. So I picked this up just a little over a month ago, and these are my first annual crediting dates for different index options. This particular carrier has a 5-year option and a 2-year option and annual options. And these particular ones, I'll talk a little bit more about those details when we talk about the product, but you can always refer back to this part of the video if you want to see what it looks like in my policy right now. This is where our index values are at this moment as of September 16th. You can see one of our index options, we're at 5.34%, one of them at 3.93, one of them at just over 3, and then moving down 2.46, and I even have some allocated to a fixed interest option. So we've got some nice diversification here among multiple different options. Of the index options that I've chosen, they're all uncapped and they have a really good opportunity for growth, as well as a lock feature. I can lock them at some point in the future. Really, anytime the market's open, I can lock it and I don't have to worry about the downside. Now, in general, when we lock things, we're trying to time the market. I usually don't recommend that. We're usually just trying to protect against some black swan event. But it is nice to know that that feature is available inside of this, especially when we're using 5-year and 2-year index options. Now, I'll talk again a little bit more about this later on in this video, but essentially with these 5-year and 2-year options, if I lock them before the end of year 5 or year 2, respectively, there's what's called a lock and go feature where it'll just restart back at year 1. So I don't have to wait for the whole 5 years to finish before I get a credit, and I'll get that growth to start compounding sooner. So it's a pretty neat feature. I'm kind of excited about it. Stick around for more details. So that's what my policy looks like. Let's look at the illustration of this product, and I'm going to tell you where it fits in my overall financial plan. Feel free to skip ahead if you want to hear about where this fits into my particular financial plan. I'm going to quickly go over the details of this annuity because understanding how this one works is kind of critical to why I'm using this in my financial plan. This is the Allianz Benefit Control Annuity, otherwise called the ABC. I'm going to scroll through this. I'm not going to go over all of this, but there are disclosures on these pages that I'm just going to scroll through it. So if you want to read about it, you can, and you're going to get the information. We don't hide anything here on this channel. So something to note, this is an indexed annuity, which means the growth is going to happen based on growth in an index. We're not actually going to be in the index, so we're protected from the market on the downside. We can get premium bonuses that apply to the income bucket that we're going to draw from at some point in the future. Our growth is, again, going to be based on that index interest. And there's extra bonuses on the income bucket. Depending on which bonus option we choose is going to determine how big of a bonus we get. There are ways to access your money, but for all intents and purposes, I don't expect to access it, and I don't recommend that we access it because there could be some potential charges, possibly even taxes or penalties, depending on how you decide to access the funds before we turn it into an income stream. There is an income rider so that we can get that guaranteed income for the rest of our lives, and it has the option to increase the income that we're drawing based on the index options that we're using. So it can go up, and when it does go up, that amount gets locked in. So it just ratchets up, even in the future after we turn it on. Now there are certain circumstances where the income can double, and that usually has to do with being unable to perform certain daily activities, and so you could double the payout in those situations. Those are kind of the basic benefits of it. Feel free to read through this if you want to see a little bit more details on how they represent it. This page discusses how you can earn the interest. Basically, you can earn it based on the index growth, or there's a fixed rate. And we have the index lock available. We have the potential for increasing income. I mentioned this a little bit earlier, but after you turn on the income stream, it's possible that your amount of withdrawal continues to go up. In this situation, here's a short little graph. It shows you start out at $4,000 that comes out. The index goes up by 3% in a year, and your actual payout goes up by 3%. And then it stays there. It just ratchets up. So it's a pretty neat feature in these types of indexes. Here's a little bit about the two different buckets. We've got the protected income value bucket and the accumulation value bucket. There's an example of how that grows. This is for the other option if you choose the balanced instead of the income. So there's the example of how that works. And if you pay attention to those graphs, you're going to see, oh yeah, now I understand why he's using this one for the income. It can still do okay on the cash side, but realistically, if I'm going for cash, I'm going to use a different annuity. And here's another example of how this annuity might be used by somebody, how she can continue to get increases throughout her life. And here's a short FAQ answering a few questions. Now, there is the ability to add premium to this for 18 months. So you can start out, the minimum is $20,000. You can add additional premium up to $25,000 unless they approve a larger amount. And we can do that additional premium for up to 18 months. Now, this one's kind of important. What's the difference between the protected income value and the accumulation value? The protected income value determines the amount of lifetime withdrawals taken out under the income rider, the guaranteed withdrawal benefits rider. The accumulation value is if you want to take it out in a lump sum. So there's some information about the withdrawals, some more information about the withdrawals, what is indexed interest, talks about RMDs, when can you start with the lifetime withdrawals? So anytime after age 50. These are the multipliers. So based on the accumulated value, when you turn on the income stream, you're going to take your age, the value of the bucket, and then multiply it times the appropriate number. Now in our case, and you don't have to decide this at issue, but you can do a single life withdrawal or joint life withdrawal, and we expect that we'll probably do a joint life withdrawal, but it really just depends on our health. If it's clear, since this is in her retirement account, my wife's retirement account, if she's really healthy and I'm less healthy when we go to turn on the income stream, we'll probably do a single life withdrawal, expecting that she'll live longer and she'll get a higher payout. If it's a toss-up, we'll just go with the joint life. The difference isn't a huge amount, but it's significant enough that if one choice stands out over the other, meaning if it's clear that she's going to outlive me, we'll choose that single life withdrawal. So here's some information on that income multiplier, how you qualify for that, the activities of daily living, how withdrawals are taxed. Can you annuitize the contract? Yes, you can. However, we're going to look at the illustration. I'm going to show you why that's probably not going to be how you do it. Basically, the benefits are so much better if we use the lifetime income rider. And some information about what happens if you die before you start drawing that annuity. So that's that. Let's take a look at the current rates. These are the current rates you can see as of August 27th, 2024. The immediate bonus is a 25% income value bonus. Fixed interest account is at 2.8%. There is no charge for the index allocations. That is one thing that can change. There could be charges later on. Those charges would only apply to the actual cash accumulation value, not the income bucket. These are the bonuses for the income option. These are the bonuses for the balanced. And then we have all the different index options that are available and the current participation rates, caps and participation rates. The important thing to remember is those numbers can change depending on the overall interest rate environment, how the general fund at Allianz is doing, and how much they can allocate each year to purchasing the index options. So the index options, the cost of those index options can vary. And so that's when you tend to see changes to these participation rates. Now these rates are all really good. One thing I want to point out is we have 5 years on some of these index options. They're a 5-year point to point. Because we have that lock feature, we have different percentages for each year here. What that means is if I allocate $10,000 to the Bloomberg index option, the 5-year point to point, during that first year, my participation rate is going to be 165%. So if I lock that in, I'm going to get, let's say I lock that in at a 10% gain. That 10% gain is going to get multiplied times 165% participation rate. My credit will be 16.5%, not counting the bonus. Now in this case, I use the 250% income bucket bonus. So in this case, that's going to be 16.5% times 2.5 times 250%. The actual credit in the income bucket, if I lock in year 1 and that index has a 10% gain, the actual credit's going to be 41.25%. That's pretty nice. What if I don't lock it that first year? If I let it ride into year 2 and I lock it in year 2 instead, let's say it just stays flat in year 2. It's still at 10% gain in year 2. It could go up, could go down. We don't know what it's going to do. But for whatever reason, I didn't want to lock it yet. We're going to get a 185% participation rate in year 2. And if we wait till year 3, we get a 205% participation rate. If we wait till year 4, 230, and year 5, we get the full 255% participation rate. Now, if I lock it early, it just starts over back at year 1 if we lock it early. Now, these participation rates are locked in when I first start that annual point to point. But when I lock, it's called the lock and go. When I lock at my anniversary, it's going to start over back at year one with whatever the new current participation rates are. So those rates could be higher or lower, but it's important to understand that. That might be one reason why you might not lock in a particular year. You might wait it out. Maybe the rates have gone down and you'd rather continue to get this much higher appreciation number. Now, going off the earlier example, let's say we get a 10% return after 5 years. Now remember, I'm only like 1 month into mine and we were at 5%. Now that included the participation rate. That did include the participation rate. But let's say we're at 10% after 5 years. We're going to get 255%. So that means we're at 25.5%. And then we're going to get the 250% bonus on top of that. That means our credit's going to be 63.75% in year 5. That's not too bad. Now, if we did wait 5 years though, we didn't get any compounding during this time. But that's basically the equivalent of like a 12% return each year. It's not a compounding 12% return. Might be more like a 10% compounding return. But it's still pretty good. And if we look back at the history of these indexes, when you go over 5 years, you're generally well over 10%. Like we could end up at like 40% or 50% or even better. And in those situations, we get really strong growth. We're going to see some examples of that in the illustration, and we're going to hop over to that in just a second. So hopefully this made sense. If you have questions about that, feel free to put it in the comment section, or if we ever get together, you can ask me in our one-on-one Zoom meeting. This is the illustration here. This is going to show us what the potential might look like based on whatever assumptions we're going to put into this. Now, the thing to understand about indexes, in whether it's life insurance or annuities, we don't know how the index is actually going to perform in the future. We know what it did in the past. We can even look and see what it did before the index was even around, so it can get back tested for a longer history. But we don't know what it's going to do in the future. And realistically, it could do anything. We could get zeros every single year from here on out. Is it likely? Not based on our actual experience with this thing, but technically it's a possibility. So we got to be aware of that. Now, the assumptions that are going to be made in here are going to be based on previous 10 years, previous 20 years, and then we're going to look at guaranteed rates. Here's your basic information. I'm going to scroll through this so you can read if you're interested in seeing the details. But we're essentially going to get to the numbers so we can see what's possible. I'm going to be illustrating joint lifetime withdrawals in this illustration. And we're starting our income in year 20. You can see it's a 45-year-old female. So this is going to be at age 65 where we start our income. Just a typical retirement age. Now, for us in particular, I'm thinking we might end up starting to draw it at 60, but who knows? It'll just depend. With this particular annuity, before we start to draw the income, we're going to get that 250% bonus on top of whatever the index credit growth is, on top of the participation rate. As soon as we turn on the income, it's going to revert to 150% participation rate. It essentially switches to the other bonus option. So we want to delay it as long as possible within the confines of the rest of our financial plan because we're going to get some better credits. But essentially, we're going to turn it on when we think we might need the income or when we might best be able to optimize receiving that income. Let you see the information here. Here's the potential starting allocations. This doesn't quite match what I have in my current policy. I actually went with a 1 year instead of this 5 year here. I have these other two, but I didn't have this one. And ultimately the plan is in future years, I'm going to be switching to 5 year index options because I get that higher participation rate and I have the lock feature. All right, we made it to the numbers. This is hypothetical values based on the most recent 10-year calendar period. And this basically shows you how the calculations would work during that time period. It takes the last 10 years and then it repeats every 10 years. Is that going to happen? No, it's definitely not. We're not going to get the exact same results every year that happened for the last 10 years and then repeating. But this gives us an idea of what it might do if that happens. And then the next page will be a 20-year period. And so it's going to give us just 20 years. So it's not going to give us 30 years. This one gives us 30. The next one gives us 20 years, but it also looks back and gives us a 20-year history of the index. This is our cash value bucket. This is our income bucket. And you can see how the growth is going to be different between those. Now there's an immediate bonus, that 25% bonus on the income bucket. So that's why this one immediately starts out quite a bit higher. Now I have 20% allocated to the fixed indexed account, which is why we get a credit in that first year. It's just a very small credit because this is the only one that's going to pay out a credit in that first year. Now the other one is a 2-year, and we're going to see that kick in here in year 4. Presumably, it's because when you look at that 10-year history, that 2-year basically didn't get hardly any credit in that first year. It got a little bit, but not much. And then it got a good credit 2 years later. Then the 5-year credits kick in, and it really jumps up our protected income value because of those multipliers and that 250% bonus. The cash value itself, it jumps up, but not nearly as much. That's why this annuity is designed for income. We want to see this income bucket grow. You're going to understand more when I get to where I'm positioning this inside of my portfolio. But what's possible with this? Under the scenario of what happened over the last 10 years, if we draw income at age 65, this is a joint lifetime payout. Means it's going to pay this out as long as one of us lives. We started by putting in $100,000, and we're potentially going to pull out $49,000 a year if we wait until that time. And it's only going to ratchet up. So what we see happen here, the index continues to go up, and the payout goes up right along with it. The payout continues to go up. This gets multiplied by this, and it turns into that. That's how the numbers work. Whatever the growth is, this is 150% of what the actual indexes grew at, gets multiplied by what we got paid out the year before. So this went up by 41.32% to become this number. This number went up by 0.21 to become this number, and so on and so forth. By the time we get to age 75, we're potentially pulling out $130,000 a year as guaranteed income because it's never going to go backwards once it goes up. Now, we've got some assumptions that the index is definitely going to perform the way it has over the last 10 years. I don't know how that's going to play out, but I'm excited to see what's going to happen inside this thing. Let's look at the 20-year period. Here's the most recent 20-year period. You can see this one only goes to age 65, so we don't get 30 years. But based on what happened over the last 20 years, our numbers are actually even better than when we just looked at the last 10. And the last 10 have been pretty good in the markets. Under this scenario, we could potentially start with almost $80,000 a year at age 65. That's some exciting stuff. Really solid growth if we waited the full 5 years on these indexes and they performed like they did in the past. We get some really big index growth, big growth on this protected income bucket. Lofty, lofty goals. Am I going to rely on this? No, I'm not going to rely on it because it's not guaranteed. Let's look at the guarantees. When we just look at the guarantees, this is the total opposite end where it's going to assume no growth in the index at all, ever. All of the index options that I have to choose from inside of this, none of them do anything. I get 0 credit. There is a small growth guarantee. We see that happening in here. But when I go to draw income, if it's been 0 every single year here, I'm going to pull out about $4,700 a year. Ooh, that's going to be a big disappointment if that happens. I definitely don't think that's going to happen. I'm already up at 5% this year. And if I were to lock one of those options, that's over 12.5% credit that I would get just that year, just this year, after I figure that 250% bonus. I'm already there. And in fact, I already have money that's in the fixed interest account that I know is getting 2.9%, and I'm getting a 250% bonus on top of that. So that one's going to be a 7.25 credit. I already know that I'm going to get that. So is this going to play out this way? Nope, it's not. It's possible that I don't lock in the indexes and they go to 0, but I already have that fixed interest account. I'm already going to be getting that credit. So I'm not concerned about this number here. But the way that I have my plan set up, even if this played out, it doesn't matter. It's not going to ruin my retirement. So let's talk about where this fits into my overall retirement plan so that you can understand why I would get into something like this that has good potential, but a perhaps devastating downside on what could be a significant amount of money, $100,000 going into it. And certainly $100,000 in something else could do different. We don't know if it'll do better or worse. I mean, I could have put 100,000 in the market and it's subject to the ups and downs. If we look at the history of the market, we know that it's probably going to be up and it could be better than this, but we don't know. There's no guarantees and there's no downside protection. So let's see where this is positioned in my overall portfolio. Now, I don't have a visual aid for this. I will be creating one so that we have something that we can reference when I'm talking about this stuff in the future. But essentially, I have a lot of money that I've put into my whole life policies. I have some money that I've put into my IULs, and I've just recently started some IULs that I'm going to be putting a significant amount of money into. After-tax dollars, my after-tax dollars go into Roths and my life insurance. And I'm going to have a significant amount of money in the life insurance, a less significant amount in the Roths, unless I do some conversions before we get to retirement, and that is part of the plan. But just strictly dollars, when we're from today until then, I'm going to have a lot more money inside my life insurance policies. Now, the reason we do that is because that money is accessible. I can use those to purchase other assets. That money is not tied up. I don't have to pay penalty, and I don't have to pay taxes when I access that cash value. There's a lot of value in that. It's also going to help supplement any retirement income that I'm going to need when we get to that point. So, life insurance, after-tax dollars going into that, significant amount. We're building that up. We could use that for whatever we want to throughout our life. I have real estate. I have a commercial building in Washington. We've got a restaurant in there. We've got some apartment units up above. One of those is a short-term rental. We have some diversification among our investments with life insurance, real estate, and of course, we've got some investments in the stock market. And that's mostly, at this point, qualified funds. I've decided to shift what's at risk in the market to just be in my qualified funds for the time being. That may change in the future. I'm not against having an after-tax brokerage account, but at this point, I don't really have a need to use an after-tax brokerage account because I'm putting so much money into my life insurance policies and meeting the particular needs of growing my infinite bank, having a nice high death benefit, and still having access to it so I can buy other assets because I do plan on expanding my real estate portfolio. When we max our retirement account, I have a solo 401k. When I max that out, I'm putting in $132,000 a year. We've still got another 15, 20 years of that before we expect to get into retirement. So I'm going to have a significant amount of money in qualified accounts. There's going to be a plan in the future to convert that to Roth. I don't know what that is yet, but there's going to be something to do with real estate, possibly other assets that we're going to use, get some depreciation, offset some of that when we do the conversion so that we're not paying a bunch of income taxes when we do those conversions. That'll happen in the future. I don't have a specific plan for that yet. I just know it's out there and I've got a decade at least to figure this out. In the meantime, there's a significant tax advantage if I'm max funding my traditional retirement accounts. If I'm putting $132,000 in there, I'm saving over $40,000 in taxes this year. So I have the option of not contributing to my solo 401k and paying the government right now an extra $40,000 in taxes. Or I can contribute to that, save on the taxes, and figure out a decade from now how I'm going to convert that and get it out at a reduced tax rate. Maybe even no taxes. I don't know. Might be a possibility, might not. I don't know how that's going to play out. But you can be sure that I'm going to be sharing it with you along the way as we do this. So be sure to like and subscribe and follow along when we put out our videos if you're interested. Now, because I anticipate that we have another 15 plus years, I'm going to have probably, I'm definitely going to have at least $2 million built up in that solo 401k. That's not even counting growth. That's like just putting money into it between now and then. And I already have money in it. We've already been putting money into it. So how much of that do I anticipate needing for guaranteed income in retirement? That's one of the questions that we need to ask ourselves, because it is nice to have guaranteed income in retirement. Go back and watch my Annuities 101 video if you want to get some information on that. But essentially, we know that there's basic expenses that we're going to have to meet in retirement. Those basic expenses are best met with guaranteed income. We know that that money's coming in every single month, no matter what. A podcast I like to listen to calls it the minimum dignity floor. What's the minimum amount that you would like to have on a guaranteed basis to make sure that you can live your retirement in dignity? You can cover your housing, your food, and other necessary expenses that allow you to live in dignity. It doesn't have to be extravagant, doesn't have to provide for travel, just provides dignity. We like to meet that need with guaranteed income. Now, that doesn't mean you have to buy an annuity 20 years before you retire to meet that income. We're going to have Social Security that will help meet that. We're going to have potentially a pension. Some of you still get pensions out there. I won't have a pension, but a pension can help meet that need. And we can take our assets at that time, convert it to cash, or maybe it is cash, and buy an annuity or annuitize it. We don't have to have an annuity product from the insurance company. There are different ways we can turn things into income streams, but an annuity is one of those options. And that's where we're looking to use this. So when we think about how much we want, I don't have a specific number yet. I don't even have a number in my head. Normally, I don't think about getting an income annuity until I get within 10 years of retirement. This was the traditional thinking that I had. And that's because when it comes to guarantees, there are a lot of really good income annuities that have guaranteed roll-up values, guaranteed growth for 10 years on the income bucket. And when we look at that, we know if you wait to draw this income for 10 years, we know how much it's going to grow and what the payout will be. And if I know that there's a specific number that I need to hit, we can use those annuities to meet that need. I don't view this annuity as doing that job because the guarantee is so low. The guarantee, remember, was only $4,700 a year. If I were to get into one of those other income annuities, in 10 years, I could probably get, if I was already within 10 years of retirement, and we get 10 years of guaranteed roll-up at 7.5% interest, compounding, I might be able to pull out $20,000 a year, guaranteed. I don't know if that number is accurate or not. I'm just throwing out that number. That could be a guaranteed number. And if I know that I need $20,000 in retirement to meet my minimum dignity floor, I might want that annuity that gives me that guarantee, as opposed to choosing one that has better potential, but it could blow up. It could end up being significantly less. So in my situation, I'm opting for this one because I know I'm going to have assets in my life insurance. I know I'm going to have, assuming no growth in the market and hopefully no losses, I'll have about $2 million in the market in that retirement account to draw from. How much do I want to start diverting to income annuities right now? How much will I rely on annuities in the future to have a guaranteed income stream? This is the plan that I have as of today. The plan is I put $100,000 into an income annuity right now. The projection is we're probably going to have $30,000 to $40,000 a year in 15 to 20 years to be able to take out as an annual income stream. And that number could be higher or it could be lower. But I'm not going to rely on that number. I don't necessarily need that number. I could take the $2 million I have in the market and annuitize that at the time if I needed to meet my minimum dignity floor. So I'm giving myself, with this annuity, a really good opportunity to have strong income in the future, but I'm giving up those guarantees. And I know I'm more than 10 years out. So if I got one of those ones that had a 10-year guarantee, I'm not even going to be drawing income in 10 years. So those don't meet my particular need at this point. And this is where there's a lot of value in talking to an agent, because an agent's going to help you decide what might best meet the need that you're looking to meet. It could be one that gives us potential growth, or it could be one that gives us guaranteed growth. It could be one that gives us potential income. It could be one that gives us guaranteed income. If you've been following my channel, you know I like to diversify. So we have a bunch of different choices. This is one of those choices. So my expectation is that I have a significant amount of money in life insurance, a significant amount of money in the stock market. I'm going to have a significant amount of money in real estate. My plan is to get about 5 annuities. I'm going to have this one for $100,000. I'm actually probably going to add the $25,000 to it. I'll see if they'll give me an exception and let me add a little bit more. I don't know if they will, but I am going to look at doing that. But ultimately, I might end up with 5 of these. If I have 5 of these, 100,000 each. And when we get to retirement, I turn it on when I need them. As opposed to buying one annuity for 500,000 in a few years. I buy different annuities, $100,000 each. I can turn them on at different times because the longer I wait, the more income it turns into when I do turn it into income. Well, if I turn them all at the same time and I'm getting 30,000 on each of them, that's 150,000 a year. That's pretty good. I don't think I'm going to be complaining if we end up in that situation. And those all will have the ability to continue growing if I use this same type of annuity for each of those. My expectation is I am going to do income annuities over the next 5 years like this. It might be this one. It might be another one that's this one, but a different contract. Or it could be a different product altogether. We'll see what's available next year and the year after that and the year after that. But ultimately, I do expect to have 5 different income annuities. As I get closer to that year 5, I might look more at the guaranteed ones, but I'm also going to have some experience in how these are growing at the moment as well. And so we'll be able to look and see where's the income projection at for these right now. And that'll help me inform my future decision on which annuities to get. So that's the plan. I probably missed some things in there. If there was something that I didn't address, you have a question about, put it in the comment section below. You can reach out to me. You can schedule a one-on-one meeting with me if you want to talk specifics about maybe a way that I can help you with your situation. You can always schedule a meeting with me, even if you're not thinking of buying an insurance product. Like, I meet with people and we just talk finances and I can give you some good ideas. I have quite a broad base of experience in a lot of different areas. I'm very knowledgeable in the finance space, and I'm definitely willing to offer you some of my time if you want to talk about your financial situation and maybe get some ideas. I look forward to hearing from you in the future. We'll see you guys next time. I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.